Welcome to the AI and Big Data in Finance webinar. Let me start with a quick announcement. So Leah Stern is, Leah is from University of Washington. I'm from University of Maryland. We are very happy to join the team of organizers for this research forum. Svetlana, Markus, Maryam, and Will have been doing an amazing job, and we're absolutely delighted to help them with this mission going forward. Today, we have two distinguished speakers. Markus Pelger from Stanford will present his paper, Deep Learning and Asset Pricing. Amit Goyal from University of Lausanne and Swiss Institute is the discussant today. So a little bit of rule book. So Markus will have 30 minutes for the presentation. After about 15 minutes or so, if there are any clarifying questions, I will briefly interrupt the session and ask those questions. Amit has 20 minutes for his discussion, and after the discussion, we will open the floor to questions. As attendees, please submit your questions in the Q&A. I will then call on you during the question part. And as a reminder, please be respectful in your comments because we will be recording this presentation and we will be posting the videos of the presentation and the discussion on the website. The main part of the webinar is recorded, but the second section where we have a panel discussion will be not recorded, and we'll just proceed to that session after 1 hour. So Markus, the floor is yours. Please go ahead.
Thank you so much for the nice introduction. It's a pleasure to be on the presenting side. So this paper, Deep Learning Statistical Arbitrage, is joint work. Oh, let me, one second, share screen. Here we go. So I hope you can see it. So this paper, Deep Learning Statistical Arbitrage, is joint work with my former PhD student, Serhiy and my current PhD student, Greg Zanotti. And I want to take this opportunity to thank Greg, who has been helping to organize this webinar from the beginning. So this paper is about statistical arbitrage, and the simplest form of statistical arbitrage is pairs trading. The idea is to identify two similar stocks, and the assumption is that prices of similar stocks should be on average similar as well. And an arbitrageur would try to exploit temporal price differences between the similar assets. An example would be Jiang and Ford. These are both companies in the same industry, and we would expect that they're exposed to similar types of risk. And indeed, if I look at the cumulative returns of Ford and GM, we can see that they co-move together. Now, an arbitrageur can form a long-short portfolio, for example, buy GM, sell Ford, and I'm showing you the cumulative return of this long-short portfolio here on the right. And we can see it seems to be a mean reverting process. That means if the price of GM deviates sufficiently much from the price of Ford, an arbitrageur can buy the cheaper stock and sell the more expensive stock and bet on that these prices will move together again. Now, in order to do this, an arbitrageur would need to first find these similar stocks. Then the arbitrageur would need to learn some kind of statistical model for this process. For example, when is it going to mean revert? And then define some kind of trading rule. For example, if the deviation is sufficiently large, buy the cheap stock, sell the expensive stock. Now, the research question that we try to answer in this paper is how much realistic arbitrage is in the US equity market? And in order to answer this question, we first need to understand what is the structure of statistical arbitrage. We argue in this paper that there are three key elements of statistical arbitrage. First, we need to find arbitrage portfolios. Now, these are these long-short portfolios of similar assets. Second, we need to estimate an arbitrage signal. That means we need to understand what is the time series patterns for these temporal price deviations. And third, we need to find a trading rule. We will call this the arbitrage allocation, and that is based on the trading on this arbitrage signal. Now, this is a challenging problem for a number of reasons. We do not only want to trade in two stocks, we want to trade in the whole US equity market. And we do not know a priori what constitutes similar assets. Now, the time series pattern in all these stocks is very complex, and that also means that these time series signals that we want to extract can be very complicated. And that also implies that any trading rule can be a complicated function of many signals. Now, can machine learning help here? And when I talk about machine learning methods, I mean methods that are very flexible because they are non-parametric, and methods that can deal with a large number of parameters because they have some form of regularization. And the answer is yes, it can, but we need to set up the problem correctly. So just to be very clear, this is not a prediction problem. This is not the problem of predicting stock returns next period. So what we show in this paper, that's the right way to think about this problem, is to study the time series of residuals based on asset pricing models and learn a trading rule based on a trading objective. Now, this paper has methodological and empirical contributions. On the methodological side, we developed a new conceptual framework that unifies different statistical arbitrage methods. We propose this idea of decomposing statistical arbitrage into this portfolio generation, signal extraction, and allocation decision step. And that allows us to compare different methods and to understand what really matters and how to get an optimal solution. As the title of the paper suggests, we also propose a solution based on deep learning. More specifically, we will find these arbitrage portfolios, these long-short portfolios of similar assets based on statistical conditional factor models that also leverage firm characteristics. So two stocks are similar if they're exposed to the same type of risk factors in the same way. Then, as a second step, we find this arbitrage time series signal with a so-called convolutional neural network plus transformer. You can think of this as a very flexible data-driven time series filter that can learn any complex time series patterns. Now, this is not just some ad hoc machine learning tool that we throw on the data. So transformer methods are the most advanced and state-of-the-art AI technique for natural language processing. If we want to study text or speech data, we also deal with a time series. But text and speech data are actually some of the most complicated time series to study. And the reason is the meaning of a paragraph, for example, can depend on how the first word of the paragraph depends on the last word. So the dependency patterns in text data can be extremely complicated. And transformers are designed to extract very complex time series patterns. That's exactly what we need for our problem. Now, given that we have this arbitrage signal, we will have a flexible neural network that finds a trading rule based on a trading objective under constraints. Now, we also have a very comprehensive empirical study in this paper. So everything will be out of sample. We will study US equities. It will be daily returns for the 500 largest and therefore most liquid stocks. And we will consider the most important risk factor models to find our similar assets. And we will have a comparison of the best parametric and non-parametric arbitrage methods. So the first finding that we have is that our new solution establishes a new benchmark for statistical arbitrage. So we substantially outperform all other approaches. We will achieve out of sample an annual Sharpe ratio of 4 with our statistical arbitrage method, and that's an amazing result. We can show that we can obtain annual out of sample returns of around 20%, while we have a volatility that's around less than half of the market. Our arbitrage trading strategies will be uncorrelated with conventional risk factors and market movements. And importantly, they will survive realistic transaction and holding costs. We also show that our results are robust over time and extremely robust to tuning parameters. So it doesn't matter how many layers a network has, etc. What really matters is how we set up the problem. Now, we do not only create good numbers, we can also learn what matters for arbitrage trading. So the literature has put a lot of emphasis on finding what constitutes similar assets. We show that this is not the hard step. As soon as you have a reasonable factor model, then the performance will be very similar. So what is really the hard step is to find this time series arbitrage signal. Using our new method, we will perform 4 times as well than the best parametric model and twice as well as our non-parametric benchmark. The second important element is that we have a trading objective to extract the signal. And that's a very simple rule. If you want to get signals for trading, you need to estimate the models based on a trading objective. We can also show that arbitrageurs will try to exploit smooth trend and mean reversion patterns and will follow an asymmetric policy. So arbitrageurs will react very fast when it comes to downtrends, but be much more cautious on uptrends. I just want to give you a very brief context for the literature, and there's a very incomplete review here. So there's of course a lot of work that has about statistical arbitrage, but most of the work in this field uses in one form or the other models. So our paper is a completely data-driven solution to this problem. There's also a lot of interest in using machine learning in asset pricing, but usually the focus is on having a model that can explain the risk premium. It means a compensation for systematic risk. Our work is literally orthogonal to this because we want to explain temporal deviations from this risk premium. Last but not least, we also build on the literature that shows that you need a machine learning time series solution for a time series problem. But in our context, we will have a trading objective to estimate this machine learning solution. Now let me come now to the model. So we will have a panel of excess returns of stocks. So in our case, we will have around 500 stocks that we observe over time. Now we assume that a conditional factor model can describe these stocks. That means we have k factors. The exposure to these factors, the loadings, can be time varying because they will be functions of the information set at time t-1. Now, two stocks are considered to be similar if they have the same exposure to the same risk factors. Now, given that, we will define an arbitrage portfolio as a residual portfolio. That means the return of a stock minus its factor component. Now, the factor component can be interpreted as a fair price of an asset. And if we have an appropriate set of factors, arbitrage pricing theory implies that the expected value of this residual should be zero. Now, an arbitrageur is trying to exploit temporal price differences, so temporal deviations from this fair price. Now, we are going to consider the most relevant factor models. These will be observed fundamental factors like a market factor or Fama-French type factors. We will consider statistical factors that explain as much correlation as possible. So this will be principal component factors estimated on a rolling window. And we will also have statistical factors that leverage additional characteristics information. So we are going to use the instrumented PCA or short IPCA method of Kelly, Pruitt, and Su. In all of these cases, our factors will be traded assets. And that's actually without loss of generality because we can always generate factor mimicking portfolios. That means I will have my 500 stock returns. I will subtract the factor component, which is a traded portfolio of those, and I will get my vector of 500 residuals. I will call these residuals my arbitrage portfolios. Now, we have a direct mapping between our 500 stock returns and the 500 arbitrage portfolios given by this portfolio weight matrix. And that is completely defined once we have selected a factor model. This means my arbitrage portfolios are traded. By definition, they will be factor neutral, at least in sample with respect to the factors I consider here. And we show empirically that they're weakly correlated and mean reverting processes. Now, as a next step, we want to understand what is the time series patterns in these arbitrage portfolios. Now, what we will do is we will consider a look back window. So for the moment, I'm going to look at the last 30 business days. And I will talk more about this choice later. Now, consider the cumulative returns of my residuals on the last 30 business days. This here would be an example of how it could look like. What I want to learn now is this process more like a trend? Is it more like a slow mean reverting process, fast mean reverting process? More specifically, I want to extract signals. So I will extract time series signals for each of my 500 cumulative residuals. And those will be the information that I use to design a trading rule. I will call it an allocation function. So formally, what I'm going to do, I will create this cumulative residual returns for each of my 500 residuals. I will have an arbitrage signal function that I apply to each of my cumulative residuals. And that gives me a parameter vector of signals. These signals will be sufficient statistics to make for making a trading decision. Then I have an arbitrage allocation function that tells me how much I'm going to buy or sell of each of these residuals. And now different approaches of statistical arbitrage just assume different arbitrage signal functions or allocation functions. So it's a very unifying framework to think about the problem. Now we need an objective function to estimate the problem. So our main objective function will be to maximize the Sharpe ratio. But in the paper, we also consider alternative objective functions that include mean variance objectives or including trading costs. So what it means is I have my 500 residuals. For each, I have this cumulative returns on my look back window. I get for each of these residuals a vector of signals. Now I plug this into my allocation function, and that gives me a portfolio weight on each of my 500 residuals. Now I have a mapping from my residuals back to the original stock returns. And now I have the weight for all of my 500 stocks. That means I can analyze the Sharpe ratio of the portfolio that comes out of these specific weights. Now, this formulation has an implicit leverage constraint because we will enforce that the absolute weights on the stock return sums up to 1. So we will have at most 100% short selling, and we will also consider more stringent short selling constraints. Now we will consider 3 different classes of models for the allocation function and the signal function. The first one will be a parametric model. That means we have a parametric formulation for getting the signal and a parametric thresholding rule for trading. Then we will have a more general pre-specified time series model with a flexible allocation function, and then our deep learning solution. Next, I want to go over these 3 models to provide more intuition. So the parametric model that we choose here is based on the Avalon-Nida and Lee model, which is one of the best performing parametric statistical arbitrage models. So it assumes that my cumulative residual returns can be described by a mean reverting process, more specifically an Onsen-Uhlenbeck process. Now this process here has a number of parameters. What I'm going to do now is I estimate for each of my 500 cumulative residuals the parameters of this process. So what is the speed of mean reversion of a specific residual? What is its drift? What is its volatility? And what is its last value on this look back window? And now one can show that an optimal allocation rule is based on a thresholding rule. If a certain ratio of these parameters is above or below a critical value, we either buy or sell the corresponding residual. Now that's a parametric model, and that has limitations, obviously. Namely, when it's misspecified, it's not going to work very well. That means if, for example, my residuals behave more like a trend, this model will not work well. Or if we have multiple mean reversion frequencies, this model is also not going to perform well. Now, a generalization of this setup is based on a time series filter approach. So what is a linear filter? So if I have my vector of cumulative residual returns, let's say it's a 30-dimensional vector because I look at the last 30 business days, a filter is simply a matrix that I apply to this vector, and then I get a vector of signals. Now, what I described before was not an Uhlenbeck process. In order to estimate it, I would discretize it, and then estimating it would be essentially estimating an AR1 model. Now, an AR1 model is just a very specific choice for a linear filter. Actually, ARMA models, that means linear time series models, can also be formulated as specific choices of linear filters. Now, because we care about mean reversion patterns, a natural choice for a filter would be a frequency filter. So what we are going to use here will be a so-called fast Fourier transformation, which provides a frequency decomposition for each of my residuals. So the idea is the following. Think of patterns that are based on sinus and cosinus of different frequencies. And now our signals will be the loadings or the exposure to these patterns. So is our process more a fast or slow mean reverting process, for example? Now, all these loadings on different frequency bands will be my signals. And then I will use a very flexible non-parametric allocation function, which is a so-called feed-forward neural network. That is simply a non-parametric flexible neural network. Now, this is more general than what I presented before, but it still has limitations. It will only be able to capture the patterns that are given by this pre-specified filter. That means if the data behaves like sinus and cosinus curves, this is going to work well. But if not, it will be limited. This brings us to our solution. You can think of this as a data-driven, very flexible time series filter model. I want to emphasize again that these transformers are really the state of the art when it comes to AI and looking at time series models. So our solution has 2 elements. It has its convolutional neural networks, short CNN. You can think of those as data-driven nonlinear local filters. And it has a transformer, and you can think of this as capturing the global dependencies between my local patterns. Just to give you an example, if I want to capture mean reversion, I could estimate local curvature patterns with a CNN, then combining them cyclically with a transformer to get a global mean reversion pattern. If I want to get a trend pattern, I can get local drifts with my CNN, then combining them monotonically to get a global trend pattern. Now, we will intuitively construct pattern factors, and the loadings or exposure to these pattern factors will be my signals. Then I will use the same flexible allocation rule as before, the so-called feed-forward neural network, to decide how much to buy or sell of each residual. And that will be estimated jointly using my trading objective. Just to provide some intuition into what a CNN and transformer is, I will present now a very simplified framework. The formal model is more complicated and explains the paper, but this will provide the intuition of how it works. So what I have here as an input is my 30-dimensional vector of cumulative residual returns. And now my CNN is a set of local filters. So our optimal model will have 8 local filters. Here I'm just showing you 4 of those. You can see that they correspond to upward, downward, up reversal, and down reversal patterns, and they're based on 3 trading days. So what I'm going to do is I will represent my 30-dimensional vector as a 30 times 8-dimensional matrix that tells me if locally the data looks more like a trend or reversal type pattern. And now the transformer will connect these local patterns globally to capture these global dependencies. Now we will have different type of patterns that can be captured. So our optimal model will capture 4 different patterns. Each of these patterns is specified by what we will call an attention weight function. This is alpha I. So we have 4 of these functions. And intuitively, they capture the dependency between the last data point with the previous data points. Now, all the magic of a transformer is in this attention function. So whenever you deal with time series data, the problem is that you can have very complicated interactions between all these data points. And the way to deal with that is that you need to impose some kind of structure on it. So you need to regularize the problem. On a very intuitive level, what a transformer does, it imposes a low-rank structure that is somewhat similar to a factor model, but it does it in a very smart way that allows the transformer to pay attention to dependencies that are very far away from each other. Now you can think of these attention weights also as pattern factors, and my signal will be the exposure or the loading on these pattern factors. So for each cumulative residual, I will get 4 loadings, that means 4 signals, and based on those 4 signals, I base my trading decision. Let me now come to the empirical part. Everything that I'm going to present will be out of sample. We are going to study 19 years of stock return data, daily stock return data. We also only include the largest stocks. Intuitively, we take the 500 largest stocks, and that is to avoid trading friction as much as possible. And we'll also complement our data with 46 firm characteristics when we study the IPCA model. As I said, everything will be out of sample. The main analysis will take the last 30 business days to learn this arbitrage signal and to make a trading decision. Our deep learning models are trained using the last 4 years of data, and we use a rolling window to retrain our models. We use the last 60 trading days to get the betas, that means these, the loadings on our risk factors that we use to construct the residuals out of sample. And the main objective function right now will be a Sharpe ratio objective. Now we're going to consider the most relevant factor models. These will be observed factors like a market factor, Fama French 3 and 5 factors. And we also add momentum, short-term and long-term reversal. I will just call this Fama French 1 to 8 factors. And I apologize to Carhartt for this kind of labeling here. We will also have principal component factors. Those will be estimated on a rolling window using the last half a year of data. It will be 1 to 15 factors. And we also have an IPCA model that estimates 1 to 15 IPCA factors that include firm characteristics information. Then I'm going to compare our parametric model, that's this Onset-Uhlenbeck with thresholding rule, the non-parametric pre-specified filter, that's a fast Fourier transformation with feed-forward neural network, and then our convolutional network with transformer. Now, this is one of the most important slides, so I ask you to pay attention. Here, I'm showing the annualized Sharpe ratios, means and volatilities of the arbitrage trading strategies. I'm showing those for residuals based on Fama French factors, PCA or IPCA factors. I will have my new CNN plus transformer solution. the pre-specified filter solution, and the parametric model. We will here consider 5 pharma French or 5 PCA or 5 IPCA factors to construct the residuals. The first observation is that if I look at the IPCA model, we get an amazing out-of-sample Sharpe ratio. It's above 4. That's very impressive. We also see that we don't get the Sharpe ratio because the volatility goes to 0, but in spite of a leverage constraint, we achieve high mean returns. The second observation is that our performance is much better than the other benchmarks. So it's twice as good compared to the pre-specified filter, 4 times as good as the parametric model. And you know, an out-of-sample Sharpe ratio of 1 based on residuals is not a bad model, but it just doesn't capture everything that's in the data. We also see that the choice of the factor model to get residuals doesn't seem to be the most important choice. So IPCA, PCA, and pharma French type of residuals produce very similar Sharpe ratios. So it seems to be much more important how we deal with the time series information. And as a last observation, I'm also looking here at what happens if I do not look at study residuals, but returns directly. So I call this a 0 factor model. That means I take the stock returns, then I try to estimate a time series model from those that maximizes my trading objective. What you can see is that those models will collapse and not work very well. So why is that the case? So why should you not try to estimate a price trend-based pattern just from stock returns? So if we believe that the stock market is well described by 5 factors, and then I have 500 stock returns, and I don't have 500 independent time series, I pretty much just have 5 time series because the factors dominate those time series. And from those 5 time series, I cannot really learn a complex time series model. The second thing is, if I want to learn a model that's just based on price trends, but stock returns also have variation because their characteristics are varying over time. So when I look at residuals, I generate data that's essentially orthogonal to characteristics, and that allows me to focus purely on price trend-based patterns. Last but not least, anyone who's tried to predict stock returns knows we can predict relative performance quite well, but we can't really predict the level. Now, when we work with residuals, we're looking at a relative object, and that's much better for modeling than the non-relative object, which would be directly returns. Now, this is the same table as before, but instead of just having 5 factors to generate residuals, I show you the results from 1 to 15 factors. The takeaway here is just that if I add more factors like 8, 10, etc., nothing changes. And you see there's a lot of robustness to the number of factors. So what matters is more to have a reasonable factor model, like 5 or 3 factors. And that is why moving forward, I will focus on the 5 factor residuals. Now here I'm showing you the cumulative returns of our arbitrage trading strategies. The top are our CN plus transformer models. So here to the right, for example, you see the results for the IPCA5 residuals. And what you can see here is the results are not driven by a specific sub-period. We consistently get a very good performance. And also if we would calculate different type of risk metrics, they would look very favorable for our strategy. Now, our results are also not compensation for risk for conventional risk factors. So what I want to look here is the alpha relative to conventional risk factors, namely an 8-factor model, which will be the sum of French 5 factors plus momentum, short-term, and long-term reversal. For example, here I look at the results for 5 IPCA factor residuals. You can see the alpha is essentially the same as the mean of my arbitrage trading strategy. Both alpha and means are highly significant. You see that the R squared of this regression is extremely low. That means our arbitrage trading strategies are essentially orthogonal to this type of risk factors. And the results also hold if you consider other type of risk factors. And again, if I look at different number of factors to get my residuals, the results will be the same. Now, if you're a trader, you might say, well, I do not care that much about a high Sharpe ratio. I care more about a high mean return. Now, the point is, if your objective is a high mean return, you should use this objective when you estimate your model. So we can use an alternative objective function, which would be mean variance objective function, high mean subject to some variance penalty. All the rest stays the same. If we estimate these models, we can achieve mean returns up to 20% with IPCA or PCA residuals, in spite of having this leverage constraint that we have, we cannot have too much short selling. The point here is, again, you should use the objectives that you care about for estimating your model. And obviously the Sharpe ratio will be somewhat lower because that is not the objective anymore. Now, we have tons of further results in the paper. So we show that our results are stable over time. For example, we show that if we use the last 60 business days to estimate our signals, the results are essentially the same. That means most of the information that we need is already captured in the last 30 days. We also show that our model is very stable over time. So we only use the first 4 years of the data to estimate our allocation function and our signal function and use it for the rest of our sample. We get results that are a little bit worse, but they still perform quite well. And it just shows that the structure of arbitrage trading seems to be very stable over time. Our results are extremely robust to the choice of tuning parameters. The point here is just, it doesn't matter too much how many layers we have in our networks, etc. What really matters is what is the structure of the problem. I just want to clarify, when I say different factor models perform similarly, I'm not claiming that all factors are the same. No, the trading strategies that we get with different type of factor models are actually only weakly correlated. So there's room for, or there's scope for further diversification effects. My point is that the patterns that we observe in residuals are very similar for different type of factor models. Just also the clarification, in asset pricing, we often argue that if unconditional means of residuals, it means alphas are small, there's not much arbitrage left. And our residuals have unconditional means that are close to zero. But it doesn't mean that there's not much profitability left when we look at conditional strategies, namely based on the time series properties of these residuals. And last but not least, I want to emphasize again, we have a time series problem. We need a time series machine learning solution for this problem. If we would skip the middle part, so we would just look at residuals and then try to use a standard feed-forward neural network to maximize some trading objective, it's not going to work well. Because for time series data, you need a specialized solution. And that's what we achieve with a different kind of time series filter models. So we also learn about the structure of arbitrage. So our transformable...
Markus, I'm sorry, we have to wrap up soon. So
thanks. Thanks for the reminder. We will have 4 types of pattern factors, which we interpret in our paper. And we can also show that this asymmetric policy where we are much faster in reacting for upturns, but more cautious for downturns. We can also show that the last 14 days matter the most. And there are very specific smooth trend and curvature patterns that are extracted. Just to clarify, arbitrage trading is complex, so simple reversal momentum strategies don't work. And we show that our strategies are well diversified, but a large fraction of profitability can also be achieved with sparser rules, and that's relevant when it comes to trading frictions. So in the last minute or so, I will just highlight 2 points. One is, we also look at our model when we include trading frictions. That means we will have 5 basis points that we charge for each transaction and an additional basis point for each short position. We will have this for evaluation and estimating the model. And the main point is we get out of sample still Sharpe ratios above 1, even when we include trading frictions. I just want to highlight this is a lower bound, and we explain in the paper why that is a lower bound. And the main takeaway is that our trading strategy retains economic significance even in the presence of trading costs. What is also interesting is when we look at how we trade in the presence of trading frictions, we can show that our model learns to exploit particularly profitable periods. That means during the financial crisis, it will allow much more short positions and more trading, but is much more cautious during other time periods. And as a very last point, and that has to do with the holding periods. So here before I looked at a one-day trading strategy. Now the question is, how well do we perform if we need to hold our portfolio for B trading days, where B can be from 1 to 30 trading days? And I'm showing you the annualized Sharpe ratio, annualized mean return, and annualized volatility for these longer holding periods, where the blue line is the model estimated based on a one-day objective, but then I force my arbitrageur to hold the strategy for B days. And the orange line is if I estimate it with an objective that already has this longer holding period. And there are 2 takeaways. One is arbitrageurs do correct prices. So we see that the Sharpe ratio has a half-life of around 7 trading days. So the Sharpe ratio drops from 4 to 2 after 7 trading days. But the second observation is there's still some arbitrage that seems to be very persistent. So even after 1 month, 23 trading days, we get a Sharpe ratio of above 1. And that can be explained potentially by limited capacity or strategic trading of arbitrageurs or slow expectation adjustment of noise traders. So just to wrap up, this paper has a methodological and empirical contribution. And given that I'm running out of time, I just want to highlight my main finding here, and that we show that there seems to be a high compensation for arbitrageurs to enforce the law of one price. And now I look forward to Amit's discussion. Thank you very much.
Thank you so much, Markus, for this fantastic talk. Amit, it's now your time to discuss the paper.
Thank you, guys. Let me share screens. You guys see my screen, correct?
Yes.
Just one more second for me to get set up. Okay, great. So thank you to the organizers.
We cannot see your slides right now. I think they're on the other screen.
I see. Let me stop share and start again. Can you see now?
Yes.
Okay, good. Thank you. All right. So thank you to the organizers for having me to discuss this paper. I asked Markus, what would you like me to do? Because it's a high-tech paper and I'm not a high-tech guy. And so Markus was very nice to say, well, I shouldn't be focusing on the high-tech stuff. I should be focusing on the finance stuff, on which presumably I know a little bit. So that's what I'm going to be focusing on the finance part of the paper. So Serhiy, please keep me true. Perhaps I have a few more minutes because Markus took a little bit more time, but please interrupt me if I'm running too much over time. All right. So what I'm going to do is the agenda for me is the following. I'll give a very quick summary, maybe just 1 minute of summary of the paper. Then I'll have a lot of small picture, what I'm going to call as small picture comments, which are going to be clarifications and or nitpicking. I don't know how long will I take in that, but these are going to be many of them, but kind of not big picture things. In terms of big picture comments, I'll have 3. They're listed here, as you can see, and I'll just highlight the number 1, which is in boldface here, what the authors really are doing. That's going to be, if you want to remember, that's going to be my main comment. And you'll see that it's going to be a little bit about the semantics, but maybe I'm jumping ahead of myself. Then I get to it, I'll get to it, but that's going to be my main comment. But let's quickly start. So I don't need to spend a lot of time on the paper. Markus obviously did a good job. He has better slides on this than I do, but essentially the paper is a formalized model for 2 things. For signal extraction on what you want to trade and portfolio allocation, right? The 2 things that typically which we do in any kind of a portfolio, we want to know what to trade and how to trade. So those are the 2 things that Markus is going to be doing. In that sense, it's standard. What's new, obviously, is that he's going to do these 2 steps jointly, right? He's going to figure all of this out. The optimization problem is going to be a joint optimization problem, which makes it obviously harder, but Markus can figure out how to do that. In terms of the signal extraction, these are kinds of the pictures that Markus showed you also. Again, there's a CNN part in which you're going to try to figure out what kind of pattern we are in, downward pattern, upward pattern, and or more complicated patterns. And then there is a transformation part, which is going to take the signals and do these, what Markus was calling as the attention functions, etc. Right? Again, I don't want to spend too much time on it. And like I said, I'm not trying to be too humble about it, too modest about it. It's a little bit of a high-tech science fiction kind of a stuff. I trust Markus on all this, so I don't have anything to say about that. Just to kind of just summarize for me in terms of using a little bit of math, what the paper is doing. So the paper is going to take residuals. The N stands for a stock, is going to take residuals from the last 20 days, 30 days, or whatever, going to transform that into a signal for that stock. Again, you see the N for that stock. Using the signal is going to transform that into a weight for that stock. And all of that is going to be done jointly to do what? to maximize, for example, a Sharpe ratio, right? Or sometimes Markus didn't really have time, but in the paper, he also talks about sometimes the objective function is mean variance utility and so on, right? But that's the objective function. And the point is that these two steps are going to be done jointly. And obviously in this whatever complicated things that he's going to do. So that's basically the paper. Now, let me start with some small picture comments, like I said, clarifications, nitpicking, etc. So Markus, I'll share my slides with you later. So you don't really have to reply to any one of these. For the next 10 slides, you can sleep if you want to. Just wake up when I have the big picture comment, right? So the first thing is, well, you maximize whatever you're going to maximize, right? So there's the expectation, right? So there's an expectation, standard deviation. So how do you take expectations? It was not clear to me. What model are you using for thinking about the expected returns? You're maximizing something, but where are these expectations coming from? Second, I was really confused a little bit. I mean, do you have a zero cost portfolio or do you have a net long portfolio? On page 23, it seems like you use the normalization that the sum of the weights, the absolute weights, is going to add up to 1, which seems like the sum of the weights is 100%. But then on page 44, and in this chart, it looks like it's a standard long short portfolio, 100% long, 100% short, etc. So I was not quite sure. You will see it will matter a little bit later, but again, this is just a clarification. I'm not even there to nitpicking something. Residuals, are they calculated from the factor model with intercept or without? I don't know. Does it matter? I don't know. It doesn't matter, right? Whatever. Why is, I know you do something with the Ornstein-Uhlenbeck process, the results suck, I understand, but if you want it to suck, fine, you can use other things. Why is Ornstein-Uhlenbeck process a good benchmark to use for cumulative residuals? I don't know. Like, I think of it as an AR1 process. You can use it for returns, but for cumulative returns, I don't quite know. Okay. E part, I'm going to forget, whatever. And one, please, one request. I know you guys who have big screens or something. Maybe you can see this picture. There's actually 2 different colors on this chart. I have it printed out. I can't see it, right? Maybe you guys use big monitors. You guys are all young guys. You read everything on the computer. I can't see it. Please change color coding. I cannot make out this thing. All right. Nitpicking. All right. Now, in the Farmer-French model, when you have the zero factor model, right? So the mean return is 13.7% for your trading strategy. I know you want to focus on Sharpe ratio, but 13.7% versus the 8-factor model has only 3.4%. I mean, you dismiss the zero factor model. I love zero factor model, right? Alpha, if you look at the alpha from an 8-factor Farmer-French model, I love Farmer-French, as you can see, is 11.6%. Alpha from the 8-factor model is only 3.3%. So, I mean, I understand the Sharpe ratio is obviously higher. I'll get to the Sharpe ratio part, but I mean, 0-factor model, you're doing great. 12% alpha is nothing not to brag about. So I don't know why you're so dismissive of the 0-factor model. Now, if you look at the annualized volatility of these, for example, these portfolios, right? When you have 5+ factor models and so on, your annualized volatility is 1%. I just don't know how that happens. It's like Harry Potter, right? I don't know. How do you have an annualized volatility of 1% on a portfolio, which is either long short or 100% invested? 1% annualized volatility, you have to tell me how that magic happens, because I'm not sure as to where that is coming from. It's too low. It's a portfolio, right? 1%, I don't know what you're doing, but anyway, something to check. Again, something about nitpicking, or maybe I'll forget about that in the interest of time. So I'll forget that. Maybe one again. This is a nitpicking. I know I mean, you can see it's called nitpicking, but sometimes you have Sharpe ratio objective, sometimes mean variance objective. Usually, as you said in your talk, mean variance objective should lead to lower Sharpe ratios, but not always, right? If you look at Farmer-French factor, you have a mean variance objective, but you get higher Sharpe ratios. Now, I know it's not mechanical, you're trying to maximize something, you don't have to always attain it, but somehow, sometimes if you have mean variance objective, you do get higher Sharpe ratios than you have a Sharpe ratio objective. So something again worth clarifying or talking a little bit about again why that happens. Trading costs, right? I know you said that this is what you showed, right? With trading cost, you still get a Sharpe ratio of 1, which is great. I understand, right? But if you compare the results without and with trading costs, roughly speaking, the drag that you have is about 5% difference in the returns, right? Okay. So the mean declines, which is to be expected, you're paying trading costs, but the volatility increases. I don't know why volatility increases with trading costs. What's happening to your portfolio? More important, you lose about 5% annualized, which is about 2 basis points per day, right? Divided by 250 trading days or something. You pay 5 basis points per transaction. That means you're doing only 0.4 transactions per day. That sounds too low. Unless I'm missing something in the math. Something doesn't quite add up to me as to, what's happening. Again, something to check. Again, this is only the nitpicking part. Now, I know I have like 7 more minutes, Serhiy, right? Something like that, 7-8 more minutes.
Yes, that's about right.
Yeah. Okay. So let me get to my main comment. What the paper is about. Okay, so now I'm going to talk a little slowly because it's about semantics. You may disagree with me, but I think it is important to discuss about this semantics. An arbitrage portfolio, or I should have actually, no, I made a typo. I should have written a statistical arbitrage portfolio. For example, pairs trading, that was your first slide, which is what one thinks of in a statistical arbitrage, is not just a long short portfolio. Right? Value minus growth is not an arbitrage portfolio because you can just go long value because you think it's undervalued. You can just short growth because you believe it's overvalued. You don't need to do both. You can, but you don't need to do both. Right? If I were to, I would call those kinds of regular long short portfolios as absolute portfolios. You trade long and or short side because you have a view on both sides. Arbitrage portfolio, the key word in an arbitrage portfolio is it's a relative value trade, where you buy B and sell S, not because you buy B because you think it's undervalued. You buy it because it's undervalued relative to S. The relative part is important. Why am I harping on this? Is, for example, the signals for an arbitrage trade. When I think of a statistical arbitrage trade, the signals for that have to come from both the two things I want to trade, long and the short side. So this is a picture from the famous paper on pairs trading in the RFS by Gatev, Gutsman, and Rubenhurst. Many of you might have seen this. I know it's a really bad picture. I don't know why they had such a bad graphics in this, but anyway, it's already a published paper. It doesn't matter. There are two stocks, Cancott and Uniroyal, right? So sometimes the pair is open, pair is closed, or whatever. The point, what I want to illustrate is when whatever the pair is open is because it's based not just on what Cancott did versus Cancott, I don't know how to pronounce it, but anyway, Cancott versus Uniroyal. It's what Cancott did relative to Uniroyal. For example, counterfactually, let's say Uniroyal, this is Uniroyal. If Uniroyal was not here, if the price of Uniroyal was going up, then even with the same price pattern of Cancott, you won't be buying it or whatever it is, you will be doing the reverse. Once again, to say this thing, because I know I'm spending a lot of time on this because I think it's important. The buy and sell signal for you is based only on your own performance. That's why I've highlighted this N part. Whatever your residuals are doing, residual is not an arbitrage trade. You're not ruling it out. Our residual is a different story. It's like a long short thing based on residuals. Your trades are coming from your own price signal, not from price signal of mth stock, jth stock, and so on. So all you're doing is completely fine. But your paper to me is more about technical trading rather than about statistical arbitrage. I think my take, this is my big picture comment, and if Serhiy shuts me off in some time, it's okay. My big picture, the biggest picture comment is, I think I'm discussing a paper which should be entitled Deep Learning Technical Trading, not Deep Learning Statistical Arbitrage. Okay. I have 3-4 more minutes, so I'm going to take Serhiy's generosity to now talk about a little bit more. Why is your machine not that smart? Now, I tried some of my own things. There was no hope I had that I'll beat your machine. Obviously, you are, there's no way I'm going to beat your machine, right? I just wanted to check some things. I'll tell you what I did, and then I'll get to the point. So I know you guys don't understand where I'm going. I know, so give me 2 minutes. I'll explain to you, okay? So I downloaded the data from CRISP, standard CRISP share code 1011. I took the top 500 stocks the same way that you do, chosen 60 days. I calculated residuals from Pharma French model. Sample period is 98 to 2021. 24 years. Okay, for me, I'm going to look at standard reversal strategies. So the signal is going to come either from past cumulative returns or past residuals. Okay, based on some windows, I'll show you. And the allocation function is going to be very simple. I have 500 stocks, deciles, so 50 short, 50 long. So I'm going to have a weight of -2% in the short side, +2% on the long side. So, right. So I also have those two things, but unlike Markus, I'm doing it separately in some sense, right? So obviously my machine is really naive compared to what Markus has. This is the first set of results, right? So there's lots of numbers, very busy slide, but I think maybe you want to look at only this. When I saw it on the last 5-day returns. Why 5-day? Because Lehman had a paper in 1990, weekly reversal. I also look at 22 days based on Jagdish's monthly reversal. I also look at 1-day return. Why not? So, but ignore that, right? Sorry, bad joke. Right? So weekly returns, right? So when I look at weekly returns, and depending on whether I skip or not a day, my long short portfolio, I can generate an alpha, 8-factor alpha of 17%. Obviously, I don't get Sharpe ratio of 4. You know, you are a master of that. I can't do that. Sharpe ratio of 1 is not bad. It's a very simple thing. If I skip a day, I get a slightly higher Sharpe ratio. It's not bad for something that I can do in half an hour. Again, you know, I'm not trying to please, you know, you guys understand, right? I'm not trying to say how smart I am. I'm just trying to say a stupid me can get an alpha of 17%. I like alphas. I know you like Sharpe ratios. I love alphas. I do much better in alphas than you do. Okay, so whatever, this is something which happens. By the way, volatility of my portfolios is 25%, which makes me happy, right? This is what I'm expecting. I can sort on residuals. By the way, there are a couple of papers. Again, I'll share the slides with you. You can look at them. There's some research which shows sorting on the residuals leads to better momentum or reversal strategies. Again, if I sort on residuals and you look at weekly, I get alphas of 16% annualized, Sharpe ratio of 1.3. Obviously, again, I'm not doing as well as you. My point is, I think, so I mean, I don't know how to say it, but in terms of alphas, I'm doing a lot better than you. I know that's not your goal. If you were to maximize alphas, if that was your objective function, you probably will go, most likely you will do much better than me also, right? But just doing a simple thing, I'm not doing so badly. So the question, it's a rhetorical question, I'm being a little bit of a jerk in that sense, is in me asking, why is your machine not that smart? I mean, of course it's smart, but why is it not that smart? Now, I have 1 more minute and I'm going to stop this. Well, since I think you're doing basically technical trading, the benchmark should be other technical trading rules. Why? Who cares about this Austin-Uhlenbeck process? You know, is this a stupid thing to benchmark against? That process does so crappily. Sure, you know, I would advise you, these 2 books are available on Amazon. Buy those books, read those books, think about technical trading. If you don't want to buy those books, read this paper in the JF 1999. They discuss, you know, I know you guys can't really see it, tons of technical trading rules. Benchmark your performance against those technical trading rules. That's it. I don't have anything more. Overall, it's a great paper. I'm really glad that I got the chance to discuss this paper. And I wish you good luck with the publication process. Thank you.
Thank you so much, Amit. Great discussion. So we now have time for questions from the audience. Just a reminder, if you have any questions, please post them in the Q&A. For now, I can see Will ask one question. Like, Will, would you like to ask this question directly?
Sure. Great presentation and discussion. This is very much related to Amit's discussion. When we think about pairs trading, the current formulation is not really about pairs of assets. I'm wondering, you know, do you intend to nest that in the formulation? There is a way to do it. You can pick a pair, form a long short portfolio of the pair, call it an asset, and look at its residual dynamics over time. That would fit into this framework. But then the question is pushed into, you know, which pair? That goes back to the challenge you point out in the literature. So that was my main question.
Can I respond?
Yes, please.
Yeah, first, Amit, thank you so much for the great discussion. They're great points, and this is very helpful for us. I feel I did not do a good job in explaining a little bit better why pairs trading is a special case of what we are doing. And why, in my opinion, this is the way how you should think about arbitrage trading. But just to give you the example with Ford and GM, if we believe the reason why Ford and GM should form a pair is because they're in the same industry, then I could construct an industry portfolio, car manufacturing industry. I take an average over how many companies we have, there 5 or whatever. And then I buy Ford and sell this industry portfolio. And then this would be my pair in some way. But the way how you can think about it is a factor is just an average of similar type of assets. So I think that using factors to construct a mimicking portfolio that is as close as possible to what I care about is really the way of a pair, but the pair I'm comparing it to is a portfolio of all the other possible similar assets. So instead of benchmarking Ford against GM, I benchmark Ford against, which car companies do we have left in the US? I'm not sure if Tesla is a good example. I take an average of all the other car manufacturing companies and say that should be the benchmark. So I believe there is an arbitrage type element because you are comparing relatively one asset to something that's as close as possible, but based on other assets in the market. Does it make sense? So it has the, just to make it clear, so there's also an idea of finding bigger picture again, ideas of clustering algorithms. So the point is not the clustering algorithm, but you have something you want to find averages of similar stuff as a comparison. A lot of this is equivalent to using a latent factor model and using the latent factor portfolio instead of an average over a cluster of similar stuff. So I view it as actually more general and really targeting relative pricing at its core. I know I'm breaking rules here right now, but I will respond to one point because I think it was very prominent. This Ornstein and Uhlenbeck idea, it was not ad hoc. I mean, there is a literature. When I say it's like an R1 process, things are a little bit more complicated, of course. And I understand we can talk about stationarity, non-stationarity. You can estimate in a specific GMM type context or MLE type context, and then it looks like you're running an R1. Let's keep this technicalities aside. But so there is a literature that has run comparisons between different models, and that was one of the best performing simple models. And we also think it provides some intuition for the problem. So are there other benchmark models? I mean, obviously, but it is not an ad hoc choice because, again, this is used as a benchmark in this literature.
Okay, thank you, Markus. We have time for maybe one more question. So let me just read the question. It would be faster. The question is from Mehmet Sagalam. The question is if you considered a high-frequency intraday application of this approach, perhaps using a zero-factor model if you cannot construct these factors within a day.
So this was a high-frequency version of this model. We have not done it. So the way how we thought about it, a different interpretation, if we don't want to use this whole arbitrage labeling, you want to earn a risk premium, like a market risk premium or a value risk premium. And I look at temporal deviations around this risk premium, and that's what I'm trading around. This would be a different interpretation. Now, all what I'm saying is trying to understand temporal deviations that are systematic can be applied potentially to any type of frequency. We haven't done it to high frequency because our view was a little bit more, how do we, you can think of this here, I want to earn a certain risk premium, and now how can I boost earning my risk premium strategy by trading around it in some way? And that was a perspective that we had, and that's why we use this type of time horizon, because that's what it relates to. All of the technical tools, I completely agree, would be interesting to use at other frequencies, and it would be interesting to see what comes out of that. And I would assume that it would also work.
Okay, well, thank you so much, Markus, and thank you so much to all the speakers. Now we will enter our unrecorded discussion part. Before we go there, I want to make a very short announcement. So our next webinar will be next month on September the 29th. And Maryam will be presenting her paper valuing financial data. So again, at this point, we are switching to the unrecorded part of the session. If you would like to ask questions, if you have any questions to the authors, please stay put and we'll let you ask those questions. Thank you.